Let's move on. As promised, some analysis for you now on what is set to be a turbulent session and also to review what did drive Wall Street lower. I'm joined by Ashton Advisors Nick Raffley. Nick, great to have you with us and back again because, of course, you picked this not just last week, not just last month, but how long ago was it? About 4 or 5 months ago.
Yeah, it was back in May, Carsten. Thanks very much for having me back on the show. I guess first up, I'd just like to make a comment, and that is just to, I suppose, express our sympathy for the people that have lost their jobs and will continue to lose their jobs as a result of the fallout of the credit crisis. I was, in fact, an investment banker at Merrill Lynch back when the dot-com bubble burst a few years ago, and I saw firsthand hard-working, honest, very capable people being thrown out of banks as a result of really dislocation in banking and dislocation in markets. And I guess all we can say is that these people will be reabsorbed in the fullness of time, but our sympathies do go out to them.
You use that very empathetic language there, but in fairness, let's talk about the hedge funds, the ones that you're advising to sell down these troubled stocks, and many saying that led to the demise of Lehman's and Friends, the shorters. The SEC responding saying those are the ones that need to have their practices clamped down on. What's your view?
Well, Carson, with respect, I don't think that's entirely the case. I think that if one casts one's mind back to May, from our perspective, based on the work which we've done, our view is that this was really a slow-motion train wreck and an accident waiting to happen. What was going on at the time, there was euphoria in the equity markets and the credit markets. Bear Stearns had just been rescued by the Fed. But all the analysis we'd done suggested that the picture was actually very, very different. What were the things we were seeing? House prices were continuing to decline. There was an increase in delinquencies. And sort of step by step, sovereign wealth funds were stepping up to recapitalize banks. But what were they seeing? Each time they step up to write a check to take a stake of a Merrill Lynch or a Citigroup, the price would continue to fall. So they were making investments which turned into loss-making investments. And our thesis was very simple. The thesis was asset prices were falling. This was impairing the equity of financial institutions. There were investors on the sidelines that saw this as a great opportunity to step up and recapitalize. But as prices continued to fall, we figured there'd come a point at which the investors would say, that's it, enough's enough, we're not throwing good money after bad.
So
these things are just not as viable as we think that they are.
So you would deny that naked short selling contributes to the downturn in sentiment, that contributes to the perception that asset values are falling, notwithstanding the reality?
We think that in the efficient operation of markets, one should be able to express one's view, whether on the long side or on the short side.
But you don't even have to borrow those shares of naked short selling. That's the argument, that it's a carte blanche ability to go short and to destabilize a company.
Carson, it's not our view to be the regulator. It's ultimately for the regulator to decide how the markets want to be regulated. But I think that the general comment we would make is that in the fullness of time and over market cycles and investment cycles, market efficiency tends to dominate so that good companies ultimately rise and bad companies ultimately have to restructure themselves or sell themselves in some form.
Where are we at with AIG? It's, of course, so closely aligned to Lehman's because it stood behind Lehman's with many of its own assets. Now, it's just received a downgrade from Fitch. That has to put it on watch. People say it's like the executioner now with the ratings agencies. The question is, the ratings agencies, how good a job have they done, Nick, up until now? They seem to have been on the sidelines.
Well, we're quite sceptical of the rating agencies in general. One only has to look at the huge number of CDOs which were rated AAA, but ultimately, were supported by very shaky subprime securities, and so ultimately were worthless. So we're fairly sceptical in terms of, I guess, some of the, we don't take a broad swipe at the ratings agencies, but we just think that there's no substitute for sort of thorough independent analysis and assessing each situation based on its facts and based on its merits.
Let's look at the situation now, though, surrounding AIG, the insurer, because 10 big banks now putting their own money together and saying this will shore AIG up. But others are saying actually that gives them a privileged insider position to potentially wreak havoc on their own account. How do you view that?
We think AIG has issues which they need to work through. Ultimately, there is no substitute for shrinking a balance sheet. And I guess one can draw a distinction between liquidity issues and solvency issues. Banks providing funding in the short term can solve liquidity problems. But ultimately, if your assets are lower than your liabilities, you've got pretty serious solvency issues. And And in due course, the market just has to come to terms with that, whether it's a case of a restructure or a recapitalization. But AIG obviously a very, very dominant player in global insurance, and it will have material knock-on effects.
Let's talk about asset valuations within the housing market. Paulson's saying that is the root cause of all of this until we see a turnaround. But how can we see a turnaround when assets were so overvalued and then sold to gullible investors?
The only thing we can say to that is that time is a healer, and there needs to be a process through which assets are sold down and ultimately come to a clearing price. When I think about credit in the economy, I often think about the analogy of providing fertilizer to plants. And what I mean by it is this. If you provide the economy with insufficient credit, it withers and dies. If you provide the economy with too much credit, it bloats out, and then ultimately implodes. But if you provide the economy with the right amount of credit, it's able to grow in a stable, responsible, systematic manner. And what we're seeing now is we're moving from an environment where there's been too much credit to where there's starvation of credit. And we're seeing that in the banks not being able to extend business loans, consumer loans, until the banks are at a point where they've solved their own problems, where they've recapitalized, where they've recut their capital structures to more sensible structures. Only at that point will the banks themselves be able to start lending again, and we think that at that point we'll see a stabilization and ultimately a turn up in the housing market. When's it going to be? We can't see it in the next 6 months.
What role then for